Hi, it's Rich Howe from Stock Spinoff Investing. Thanks for joining me today. United Technologies recently announced a breakup, and I wanted to take a look at the stock and compare it to its sum of the parts valuation to see if it's trading at a discount. With that, let's get right into it.
Before we get started, just a quick disclosure. The information in this presentation is meant for educational and informational purposes only. I'm not providing investment advice, and you should always check with your investment advisor to determine the suitability of any investment. Let's review the United Technologies spin-off timeline. In this presentation, I'm going to be referring to United Technologies as UTX, which is its ticker. It started back in August of 2017 when Third Point urged UTX to spin off its non-core businesses, arguing that the stock was significantly undervalued on a sum of the parts valuation basis. Third Point is a very well-known large activist hedge fund. The very next month, in September of 2017, UTX announced that it had agreed to acquire Rockwell Collins, which was an aerospace competitor. That deal actually took a significant amount of time to close, over a year. There were some regulatory hurdles that UTX had to get through, but ultimately that acquisition closed in November of this year. And at the same time, management announced that it would be breaking up the company into 3 separate publicly traded companies. The one caveat was that this breakup was going to take 24 months, which was a little bit disappointing to the street. The stock actually sold off when the announcement was made. The next important point to talk about is the rationale for the spinoff, and it's really quite simple. The rationale is just to eliminate the conglomerate discount. Currently, UTX is a conglomerate which has an aerospace-focused division, an elevator-focused division, and then a climate control and security-focused division. And if you look at all of UTX's closest pure-play competitors, you can see that the stock is trading at a discount to those competitors. What I'm showing here is EV to trailing 12-month EBIT. But if you look at the same chart with price to cash flow or EV to EBITDA, you would see the same relationship, that the stock is just trading at a discount to where it arguably should be trading if it were broken up and separated into 3 separate pure play companies. UTX is made up of 3 separate divisions that really have little overlap, so you can see why it makes sense to split these divisions. The spin-off plan is to spin off Carrier as well as Otis, and that will leave the remaining company as a pure play focus on the aerospace market. So let's spend a few minutes talking about these 3 different segments. United Technologies RemainCo, so the company that will exist after it spins out the other 2 businesses, is the largest player, will be the largest player in the aerospace aftermarkets business. The aerospace market is in secular growth right now, and that is really being driven by the global middle class that's growing significantly, especially in the emerging markets, and that growth is boosting demand for flying. UTX is benefiting from that secular growth. If you just look at its sales to date in 2018, it's on track to generate approximately 10% growth in 2018, and that growth is expected to continue in 2019 and beyond. With the recent Rockwell Collins acquisition, UTX has $39 billion in aerospace sales, and it's about 50% bigger than its nearest competitor, GE, so it has significant scale. Because it has so much scale, it's very well positioned to navigate pricing and other competitive pressures from Boeing and Airbus. There is also the potential for margin expansion at United Technologies. Management has guided to $500 million of synergies related to the Rockwell Collins acquisition. And further, the company is currently losing approximately $1 billion per year selling its new geared turbofan engine. However, as engine sales volume ramp up, the loss will eventually turn into a profit. And as you can anticipate, this will lead to a very significant increase in profit and margins. The next group, the second biggest group or segment, is Carrier, and this business is focused on the heating and air conditioning market, the building and automation market, and to a lesser extent, fire and security products. This business has benefited from a very strong HVAC demand backdrop in North America and a stable housing market. The business is on track to generate mid-single-digit revenue growth in 2018. Otis is the market-leading elevator manufacturer in all regions except China. It's on track in 2018 to generate low single-digit revenue growth. It's benefiting from strong demand in the US and Europe, but has and continues to face pricing and other competitive pressures in China. Since 2011, Otis's operating margin has declined from about 23% to about 15%, but it appears to be stabilizing in that 15% range. Its margins remain approximately 200 bips higher than its competitors, even though those margins have eroded significantly over the years. Now let's move on to what we think the company's worth on a sum of the parts basis. The first segment we'll look at is the RemainCo. So this is the company that will remain after the two spinoffs happen, the pure play company focused on the aerospace market. If you look at the two closest competitors, they trade at approximately 16.1 times EBIT on a trailing 12-month basis. So if you apply that 16.1 times multiple to the RemainCo's trailing 12-month earnings before interest and taxes of approximately $5 billion, you get an implied enterprise value of approximately $83 billion. Next, we'll look at Carrier. Carrier's peers trade at a valuation multiple of 18.1 times EBIT. So again, we're just going to take that valuation or that multiple, that 18.1 times multiple, multiply it by Carrier's trailing 12-month earnings before interest and taxes, or EBIT, and it implies an enterprise value of approximately $67 billion. Finally, let's look at Otis, the pure play company focused on the elevator market. If you look at the nearest or closest competitors to Otis, we don't have the data for Schindler. We do have the valuation multiple for Cone. Apologies if I'm butchering the pronunciation of that, but it trades at 17.2 times EBIT. So if you just take that multiple, multiply it times Otis's trailing 12-month earnings before interest and taxes, you get an implied enterprise value of approximately $32 billion. All right, let's put it all together. So at the top of this chart, we just have the valuations that we already calculated for the RemainCo, for Otis, and for Carrier. Next, I looked at costs. So United Technologies had corporate costs of $766 million that were unattributed. They also had, or the company also had, pension costs of approximately $725 million. And they also had additional recurring costs. There will also be an additional $350 million of recurring costs. You can think of these costs as a dis-synergy from having to split up the company. And again, this is management's estimate. In total, we will have a little bit over $1.8 billion of recurring costs. If you capitalize that at 17 times multiple, that's the multiple on a weighted average basis that we used in our valuation. It comes out to a little bit over $31 billion, and that amount, that $31 billion, we'll have to subtract from our enterprise value calculation. There will also be between $2 and $3 billion of one-time spin-related costs. Management has guided that is related to having to separate about 1,200 different legal entities for the spinoff to happen. We can add cash of $7.6 billion, debt of $39.9 billion, and these numbers are adjusted for the recent acquisition of Rockwell Collins. Add in the pension liability of $2.4 billion, and it works out to a sum of the parts equity value of about $114 billion, or $132 per share. This compares to the current market cap of about $100 billion, or the current share price of about $116. If you believe my assumptions, then this spinoff will unlock approximately $14 billion of shareholder value, or $16 per share, and this represents about 14% upside to the current share price. All right, now let's look at some upside drivers. 14% upside is great, but I don't know if that's what management is looking for to go through the brain damage of going through this breakup, which is going to last 24 months. It's going to be quite a painful ordeal. So they probably want a little bit higher upside than just 14%. So let's look at some of the upside drivers. First off, you have the potential Rockwell Collins synergies. Management has guided to $500 million of synergies over time. So if you capitalize that at our aerospace multiple of 16.1 times, you get about $8 billion of additional potential value. Next, the elimination of the geared turbofan engine losses. As I covered earlier, the aerospace group is currently losing about $1 billion a year producing and selling its geared turbofan engines. Now, as volumes ramp up, this loss will go away and will eventually turn to profit. And so if you just eliminate that $1 billion of losses and you capitalize it again at our 16.1 times aerospace multiple, it could create $16 billion of additional value. The third potential upside driver is the premium that the aerospace division could garner in terms of its valuation multiple. It's going to be the leading aerospace aftermarket company. As I mentioned earlier, it's going to be 50% bigger than its closest competitor, GE. So if you assume that this aerospace company deserves to trade at a premium, let's just assume a 10% premium, multiply that 10% premium times our enterprise value for the aerospace segment, and you get an additional $8 billion of potential value. All right, let's put our upside valuation together. Our initial sum of the parts equity value was $114 billion. If you add $8 billion of value for the Rockwell Collins synergy, $16 billion for the elimination of the GTF losses, and about an $8 billion value or additional value for the aerospace premium, it works out to a sum of the parts upside valuation of $147 billion or $170 a share. This compares to the current market cap of $100 billion and the current share price of $116. It represents approximately $54 of upside per share, or $46 billion on a market cap basis, or 46% upside. Now, why does this upside potentially exist? A couple reasons. This is usually the case when there is a spinoff. This is the reason that management went ahead with the plan for the spinoff. It's going to take 2 years, so it's not like this value creation is going to happen immediately, but there should be some pretty decent upside over the next couple years if United Technologies is able to execute on this breakup. I wanted to thank you for joining me for this video. This concludes the video. As always, feel free to reach out to me at rich@stockspinoffinvesting.com if you have any questions or feedback. Have a great day.